Hi, Todd VanDenburg here with VanDenburg Capital Management and another Uncommon Sense update. So for the last month, the markets have been on another roller coaster ride. We're a little higher than we were a month ago, but boy, has it been a traumatic ride. Here's a quick chart. You can see that about a month ago, we had a big dip, and then we climbed back up nicely and quickly, and then we had another dip, and then we climbed up, and now we're back in the dip again, but we're still ahead of where we were a month ago. So, this is sort of the new normal as the market settles out, to deal with, inflation and the possibility of recession and all these other fears that are, sort of permeating the media these days. But that's not what I wanted to talk about. Today, what I want to talk about is this new inflation number that just was released this morning. And, the headline was, inflation hits highest level in 40 years, 9.1%. And buried down in the details of the article, it says, and the experts expected 8.8%. So the reality is that we were really expecting a high inflation number anyway. So is the difference between 8.8 and 9.1 going to change the world? And my answer is no. It was already baked into the cake. We already knew this was going to happen. But when that report was announced early this morning, the market futures tanked. We were supposed to open up down like about a 1.5%. And as I look right now, I will check real quickly. I think the markets are down maybe 0.2% right now. So, the markets are basically coming to realize that, yes, we're in an inflationary environment, but it looks like there might be some change coming. And I say that because I've been following, gas prices, and the high gas prices have been a huge cause of some of our inflation. Not all of it by any stretch, but it has been a major contributor. And so what I've noticed here over the last month is that gas prices have actually started to fall. So here's a chart from AAA. It shows about a month ago, gas prices were just over $5 a gallon. And nationally, that's a national average. And right now they're sitting at about $4.63. And anecdotally, my wife mentioned to me this morning that I think she saw gas was like $4.17 a gallon where we live. So if you pull California and it's $6 a gallon gas out of the equation, the national average is somewhere a little above $4. And so, but it's coming down, and as it comes down, that's going to trickle through the rest of food service and food delivery and transportation, and all these other areas are going to start to soften from an inflationary standpoint. But it's not going to get rid of all of our inflation, because as I've said in prior updates, the reason for our inflation is not like in past inflationary times when the economy was just accelerating so fast that the economy just couldn't possibly keep up, right? And that's not the reason that we have inflation right now. We have inflation right now because it isn't that the U.S. economy can't keep up with demand. It's that we suppressed the U.S. economy, and at the same time, the government injected tons of money into the economy. So it immediately created this imbalance that until that imbalance is addressed, inflation's not going to get back down to the 2.5% range that the Fed would like it to be at. Now, the Fed's going to continue to increase interest rates, and they do it, saying that they're trying to, counter inflation. But when Chairman Powell was asked recently in some congressional testimony, is the increasing of interest rates by the Fed going to lower gas prices or food prices, he reluctantly had to say no. So while what they're doing, I agree that they should raise interest rates, because interest rates are one of the few tools that the Fed has to try to control the economy if it's really structurally flawed. And by keeping interest rates at near zero for so long, they'd given up one of their tools. So I agree with the concept of raising interest rates. I just think that they need to do it a little more judiciously, because if they raise interest rates too quickly and raise them too high for too long, then they're really going to have a slowing effect on the U.S. economy, and then they're just going to potentially protract any potential recession that we might go into. So it's not a guarantee that they're going to do all these dumb things, but we're watching it really closely just to make sure that if they continue too far down this path, while there might be some other opportunities for us in fixed income to get some decent returns in a fixed income environment, we are going to have to be careful about the equity world, because equities, if they slow down the U.S. economy and basically put their foot on the neck of the private sector, getting out of a recession could be difficult. So that's a little bit of our concern, but it's not a guarantee. So I'm not losing sleep about it every night, but I am watching it super closely. So and I think you should too, because it's very real what's going on right now. While government manufactured, right? The government borrowed a bunch of money from the future and injected it into the economy, and the government shut down, basically goods and services for the better part of a year and a half in order to, protect us from COVID. And right, wrong, or otherwise, we now find this imbalance. So we got to work through this imbalance to get to the point where we don't have so many excess dollars chasing limited goods and services. We need to get back up to where we were pre-pandemic and get ahead of it. And something that leads me to feel like we're heading in that direction, in spite of what the Fed says or what the Fed does, is just one final chart that I'll leave you with, and that's from TSA checkpoint, people going through TSA checkpoints. Now there's a chart here, comes from First Trust. I love this chart because you can see pre-pandemic 2019, you can sort of see where the number of people going through TSA checkpoints. That's a gray line, and then I'll show you just on with a quick line here where we are today, and we're nowhere near we were at the pandemic lows, and we are getting closer to where we were pre-pandemic, and we're trending in the right direction. So as long as we can continue to trend in the right direction for some of these positive leading indicators, I mean, people don't fly because they don't have the intent of doing something with money when they get to their destination, right? They're going on vacations, they're traveling for business. These are good forward-looking indications, because once they get to their destination, they start spending money, and that has a positive impact on the economy. So don't get too riled up about the inflation numbers. They are high, but they're artificially high. And as long as we can keep the government out of the way, like, please, government, do not create another bill to stimulate the U.S. economy. We don't need more dollars in the U.S. economy right now. What we need is the ability to get everybody who was working prior to the pandemic back working, and we need to get them producing goods and services so that we can fix this imbalance between cash available and the availability of goods and services. So sort of a lot to cover there, but it's the headline of the day, so I thought I'd talk a little bit about it. If anybody has any questions about this or any other financial matter, you can post a comment to this update, send me an email, give me a call. Regardless of where I am, whether I'm in California or Texas, I'm always available, and I'm pretty responsive to inquiries. So that was your update. I hope you enjoyed it. If you did, give us a like, give us a share, and I'll be back again soon with another Uncommon Sense update. Thanks for watching.
If you'd like to be the first to hear of more Uncommon Sense updates like these, please click the subscribe button below. We'd really appreciate it. Thanks again.